How does trade balance impact commodities? Imagine a country that exports a lot of oil or metals. When its exports outpace imports, it creates a trade surplus. This often signals strong demand for its commodities abroad. As demand rises, prices for those commodities tend to go up. That benefits producers and investors because higher prices can mean more profits. On the flip side, if a country imports more than it exports, it has a trade deficit. This can suggest weaker demand for its commodities or that it's consuming more foreign goods. A trade deficit can put downward pressure on commodity prices, making investments riskier or less profitable. The trade balance also influences currency values. When a country has a trade surplus, its currency usually gets stronger. A stronger currency makes its commodities more expensive for foreign buyers, which can slow down exports. Conversely, a trade deficit often weakens the local currency. A weaker currency makes commodities cheaper in foreign markets, possibly boosting exports and prices. Since most commodities are priced in US dollars, changes in exchange rates can directly affect local currency prices. For investors, tracking these currency shifts helps predict price movements. Terms of trade are another key factor. They compare export prices to import prices. When export prices rise faster than import prices, a country's terms of trade improve. This boosts national income, allowing more spending and investment. For countries that rely heavily on commodity exports, better terms of trade usually mean higher revenues and more demand for commodities used domestically. That can lead to rising prices and better profit margins for producers. Trade balances also impact production costs. Many commodities need imported inputs like machinery or energy. If a country's currency weakens, importing these inputs becomes more expensive. Higher costs can reduce supply or squeeze profit margins for producers. When supply tightens, prices tend to go up, which can be good for investors. Finally, the overall trade balance reflects economic health. A trade surplus driven by strong commodity exports suggests healthy global demand. This can lead to increased investment in commodity markets. But if the trade balance worsens, it might mean demand is slowing or there's too much supply. For investors, understanding these shifts helps anticipate price changes and market trends. In short, trade balance impacts commodities through currency movements, income levels, production costs, and global demand. Watching these indicators gives investors clues about when prices might rise or fall, helping them make smarter decisions in the commodity markets.